Okay. Do you have the exercise in front of you?
Yes.
Okay. So you're asked to draw up an income statement, and that is the first statement that you always draw up. That is the first statement that you always draw up when preparing your financial statements. Okay. So the first thing when you draw up, the first thing you do when you draw up your income statement, you first start with the heading, which is the name of the business. You first start with the heading, which is the name of the business, followed by the name of the book, and then the date. So in this case, you are told that the following balances appeared in the books of Tangelo Traders. So the heading of your income statement will be Tangelo Traders.
Okay.
Tangelo Traders, and then you write the name of the book, which is income statement. Income statement for the year ended. So usually when you draw up an income statement, it's for the year ended. So the phrase for the year ended is very important. Name of
Okay.
Tangelo Traders income statement for the year ended. And here you're told that the last day of the financial period was on the 31st March 2012. So it will be income statement for the year ended 31 March 2012. Ne? You
Yes.
understand? Okay.
Yes.
So, and then from there, you have to draw up your income statement. Now, drawing up an income statement, I'll quickly just draw up a table. So, it usually has 3 columns. Okay. So, in the last column, that's where you always record all your final amounts. Ne? So when in this statement, both the income statement and the balance sheet statement, the last column is where you record your final amounts. That's very important. And then the second column, that's where you record all your that's where you do all your calculations, or that's where you write
Okay.
all the amounts of the accounts. Okay,
Okay.
so the first thing you record is in an income statement is sales, ne? And make sure it's less sales returns. If there are any sales returns, in other words, then inward.
Serafina, can you please zoom your screen a little bit?
Okay.
Thank you.
Can you see now?
Yes, thank you.
You're welcome. Okay, so the first thing that you record in your income statement is your sales, and make sure that if you have your sales returns, you have to subtract them. Ne? So they're all either called
Okay.
sales returns or return inwards. So it's the same thing. So now we go to our statement, we go to our activity, and then we look for our sales. What is our sales amount?
Mine is on the
Our sales amount in
two
this, yeah, it's
two one
yeah.
217.
So our sales amount is 217. So before you record the amount, you first need to check whether you have sales returns or return inwards. Now looking at this exercise, there were no return inwards. So you record the amount as it is. Ne? Make sure you record the amount as it is.
Okay.
And because this sales is the final amount, ne? This is the final amount of sales. Sales was already calculated, ne? So you won't need to calculate it any further. And you say that your calculations are done in the first column. So you record the amount in the last column because that's the final amount of your sales. It's 217,000.
Okay.
Okay. And then from there you less cost of sales. You less your cost of sales, ne? So cost of sales, you will never be given cost of sales, and therefore you always be required to calculate your cost of sales. Now, how do we calculate cost of sales? Who can tell me the formula of calculating cost of sales? Formula
Cost
of
of
calculating.
opening stock plus purchase.
So you have your
Then you
opening.
minus closing stock.
You have your opening stock, and then you add
your purchase.
your purchases, and make sure that if you have
Then you minus.
if you have purchases returns or return outwards, you make sure that you subtract it from your purchases amount, ne? So in brackets, purchases returns, or in other words, they are also known as return outwards. The same as sales. So if you have purchases returns, then you make sure you subtract them first from your purchases, and that's where you record your amount here. And then from there, the other thing that you record before that, if you are given carriage inwards, please take note that if you are given carriage inwards, carriage inwards, carriage inwards or freight inwards is a transportation cost incurred to bring your goods into the business, ne? To transport the goods from your suppliers into the business. The transportation cost that incurred is also part of your cost of sales. So in cases where you are given carriage inwards, you make sure that you add it. So in this activity, we were not given any carriage. You were not given any carriage inwards, but I will have to attach it. I will have to write it. Just so you do not forget. So it's so carriage inwards, or sometimes known as freight inwards. So there are two different kinds of transportation. There's carriage inwards and there's carriage outwards. So carriage inwards is a transportation incurred in bringing the goods into the business, while carriage outwards is a transportation incurred to transport the goods to your customers. Do you understand? And therefore, the carriage that you use when calculating your cost of sales is the inwards. Never use carriage outwards in your cost of sales. The only carriage you use is the carriage inwards, or the freight inwards. The carriage outwards is part of your expenses, so it will fall under expenses. And then from there, you less your closing stock. Okay, so how much was our opening stock? How much was our opening stock?
60,000.
Our carriage, our opening stock was 60,000. Opening stock is the stock that is always on the first day of the month or the first day of the period. So it's always on the first. Opening stock is always on the first. And the closing stock and opening stock is always the one given. Opening stock is always the one given in the trial balance. Ne? It's always the one given in the trial balance. And closing stock, normally if you are given a trial balance, a closing stock will always be under additional information. Do you understand? Do you understand? And the next thing,
Yes.
okay. So the next thing is to add our purchases. We have to add our purchases amount. Now, before you record an amount, you have to make sure, you have to check whether there is an additional information that is affecting that account. For example, before you record your purchases amount, you need to go through all the additional information and make sure there is no additional information that affects that account. You understand? Do you understand?
Okay.
Okay. Meaning that now we are at purchases,
Yes.
right? Now we are at purchases. Before you record the purchases amount, you should first check, you should first make sure, you should first check under your additional information if there is a transaction that will affect your purchases amount. Now, if we are to go through, this additional information, you are told that the owner withdrew the first one, the owner withdrew goods for his own use. Goods for his own use. And that's if what are the two accounts involved in that transaction? The owner withdraw goods. We said that when the owner takes good or money out of the business, then it's known as drawings, right? When the owner takes money and goods out of the business for his own use, then it's known as drawings. Now, in this case, the owner did not take money, but he took goods. And goods are known as purchases. They fall under purchases. And the goods are falling under purchases. So obviously, looking at this transaction, the transaction will affect our purchases. Why? Because purchases is when we buy goods. That's the account's name. When you go to see your suppliers and buy goods, that is known as purchases. Now, what the owner did is he took out goods. So your goods are decreasing. Your purchases is decreasing. Do you understand?
Oh, okay.
Yeah, and that's why in brackets, you have to subtract the 2,000, which is part of the drawings, the goods that were taken out of the business by the owner. So what is our purchases amount was 102,000, right?
102. Yes.
So it will be 102,000 minus the 2,000. Do we understand?
Yes. Yes.
Okay. And then that will give us how much? Obviously, it will give us 100,000. So 102,000 minus 2,000 will give us
1,000.
100,000. Do we understand, or are there any?
100,000.
Okay, do we understand, or are there any questions before we move on?
Now we
Okay.
We understand that one.
No
Okay.
question.
Okay, so there's no carriage inwards. Looking at this exercise, there were not carriage inwards, so we leave it. You do not record anything, and then from there, what you do is you add up all your amounts. And then they'll give you 160,000, and then you subtract.
And 60.
You
Yes.
subtract your closing stock. So how much was our closing stock? If you check down there, the additional
Our
information.
closing stock it was
Yeah.
uh,
Our closing stock was 72,000.
72,000.
Yes. So our closing stock was 72,000. Okay, and then from there you do your calculations to find your cost of sales. So how much is our cost of sales amount? And because it's a final amount, all these were just calculations. The final amount, we have to record it on the last column. And we said that if the amount is being subtracted, it should always be shown in brackets. So you should always put the amounts that are being subtracted in brackets to show that you are subtracting.
Brackets.
Yeah, so 160,000 minus
Okay.
72 is how much? 98. How much are you getting?
$100.
160 minus 72.
88.
So we are getting 88,000.
8,000.
Okay, so our cost of sales
Yes.
is 88,000, and then from there, sales less cost of sales, you get gross profit. Okay, so how much is our gross profit?
$129,000.
So we get 129,000, and then from gross profit, you make sure that you add other incomes. So from gross profit, you add other income. But looking at this exercise, we had no other income. Ne? Looking at these exercises, we had no other income. So what you need to do is we have to less our expenses. Okay. So what expenses do we have there?
We have salary,
Salaries and
wages. Stationery.
We have stationery.
Telephone.
We have telephone.
Then vehicle. I don't know if this one.
There. Oh, but hold on. Before we
Vehicle and cost price.
before we go to expenses, ne? Before we go to expenses, I just saw another income. I just saw another income there. Did you see it? Did you guys see it? Can
No.
you guys see an income there? If you check the account after purchases is
Yeah,
rent
rent
income. Yes, it's a rent income. So you have rent income. Ne? Now, before we record our rent income, we need to make sure we need to go through the additional information and check whether there is any additional information or there's any transaction that affects our rent income. Provision, long-term rent for matches, bookkeeping fix. Okay. Okay. Now in this case, if you check at
Number 4.
number 4, ne? Number 4, you are told that the rent for March is still outstanding, ne? The rent for March is still outstanding, and bookkeeping fees is 400 per month. Now, in this case, you are given a rent income, ne? And you are told that the rent for 1 month is outstanding. So, meaning, remember we said that when you draw up your financial statements, you record all information of 12 months. So, come December, let me say you own flats, ne? Come December, you realize that one of your tenants did not pay their rent for December. You will still need to record that rent as accrued income. The income belongs to this current year, so it needs to be part of the financial statement. Remember the accrual basis? The accrual basis states that an event is recognized when it happens and not when you receive the cash. Meaning that even though you did not receive the money for the rent, it should still be recorded in the financial statement. Now, in this case, you are told that rent for March was not rent for March is outstanding, meaning that the 4,000 is it the 4,400 ne? The 4,400
4,400.
yeah, the 4,400 that is in the trial balance, that is recorded in the trial balance, is only for 11 months. Do you understand?
11 months.
Yes.
Yes.
Now you have to find out how much they pay per month. Now you have to find out the amount
400
per month. So 4,400 divided by 11 months. It's how much?
11 months.
It's how much?
400.
Okay.
It's 400.
So you have rent calculations. So it will be 4,400. You divide it by 11 months, and then you get 400 per month. Per month, meaning that
Yes.
400 that belongs to March is still outstanding. So you have to add it because it belongs to the current financial year. You understand? You need to add it to the final amount, which is 4,400, and then you add it to the final amount because it belongs to the current financial year. Oops, sorry. So it's rent income, 4,400. You plus the 400, and then you get how much? 4,000.
4,800.
4,800. Okay. So we check. Do we have any other? Do we have any other income? I think those were the only incomes that we have, né? Those were the only incomes that we have. So you record the amount and add other income. So in this case, it's just 4,800 because it's the only income. So you add all your incomes together, then you get 4,800. And then from there, gross profit add other income will give you your gross income. You understand? So your gross profit and other income, you get your gross income. So how much is our gross income?
133,800.
100 and
33,000.
133. 800.
Is it 800?
Yeah, 800. Okay.
I think so. Yes.
Yes.
Phoebe, is it correct?
Yeah, I think it's correct. It is correct.
Okay.
Yeah. So okay, let's move on to our expenses. What other expenses? What other expenses do we have there? We still have a lot of expenses.
The vehicles at cost price?
Vehicles. The word vehicles. What is a vehicle? It's a car. Is a car an expense in a business?
Right.
It's a what type of account is a car? What type of account is a car in a business? Who wants to try? What type of account is a car?
Liability.
A car, something that you own. Foibe, from yesterday's session, what type of account is a car? Is an asset. It's a fixed asset. A car is your belonging.
Asset.
If you remember yesterday, we said that the car is what you use to transport. You use a car to transport goods to your customers. You use a car to go buy stock and so on. Do you understand? So if a vehicle is a fixed asset, a vehicle is a fixed asset. Okay, so let's move on. Let's move on. We still have a lot of expenses.
Oh, we still have. Oh, there's
water and electricity.
Yes,
electricity.
Water and electricity. Again, we still have more.
Insurance.
Yes.
The insurance.
Insurance, yes.
Yes.
Advertisement.
Advertisement. Advertisement is an expense, yes. When you advertise, let me say, when you are advertising, the cost that you incur, that is an expense. That is an expense. All the costs that you incur when you are doing business, yes, those are your expenses. Everything that you pay for, yeah, when you are busy doing your business. Okay, we still have expenses. I can still see some other expenses.
Bookkeeping.
Fees.
The bookkeeping fees.
Yes, we have bookkeeping fees. Bookkeeping fees.
Yeah.
I think we still have two more.
Equipment and cost of price or what?
Equipment, your equipment, those are your fixed assets. Equipment are tools, your tools that you use in the business. Those are your properties.
Oh,
Okay, now a hint. I'm
okay.
gonna give you guys a hint.
Okay.
There is at least one expenses that whenever, if you have fixed assets, you should have that expense, because your expenses lose value. Remember, your expense are not expenses, but your assets, your fixed assets lose value. So what do you call that losing value of fixed assets? Depreciation. Have you ever heard of depreciation?
Oh.
There is no way,
Nope.
there is no, when if you get a fixed asset, there is no way you won't calculate depreciation, meaning that there is no way you have an income statement with no depreciation. So you will never get depreciation. Depreciation is calculated. You will always need to calculate depreciation on your own. Don't expect depreciation to be in the trial balance or to be part of the accounts that you are given. That's very important. You should take note of that. Okay.
Okay.
Another expenses that you are always not given, ne? If you see loan, you understand? If you see loan, obviously if you take a loan from the bank today, you'll be required to pay interest each and every month. You understand? If you take a loan today from the bank, you'll be required to pay a certain amount of interest per month. So that is interest on loan, and it's an expenses because that is something that you pay each and every month. Expenses are things that you pay each and every month while you are doing business. Water and electricity you have to pay each and every month. Rent you have to pay each and every month. Salaries you have to pay each and every month. Depreciation you need to calculate each and every month, you see? So expenses are things that you need to pay each and every month when you are doing your business. You understand?
Oh,
Okay.
yes.
So whenever you have loan, the account loan, then you know that there should be interest on loan. Okay. Do we understand?
Yes.
Yeah, boo.
Okay. So those are our expenses. Now we need to record their amounts. And before we record their amounts, we need to make sure, we need to check before you record the amount that is given. You need to check if there is a transaction under additional information that will affect that account. That is the first rule. Before you record the amount of the asset, or of the expenses or of the income, you need to make sure, or you need to check if there is a transaction under additional information that will affect that account. Do you understand? So let's look at our additional information. Do we have any transaction that affects salaries and wages? Do we have any?
No.
We do not have any. Next. So we
No.
record the same amount that you are given. So how much our salaries? Our salaries are 25,000,
Our
right?
salaries are 25,000.
25,000. So the session will end itself within 2 minutes. So if it ends itself, then I'll just restart it and you guys join. Then we continue from where we ended. Yeah. Okay. So we move on to stationery. Do we have any amount that affect any transaction that affects stationery?
No.
We do not have. Nev?
We do not have. Mm.
Okay. So in this case, because we do not have any transaction that affects our stationery, we record it as it is given. So how much is our stationery amount? 500. Okay. So our stationery is 500. And then we move on. Telephone. Any additional
Number
information?
5.
Now what is number 5 saying? Okay. The telephone and water and electricity accounts for much of 550. So 540 of telephone and 200 of water and electricity have not been paid, meaning they belong to this current financial year, but they have not been paid. So, but because they belong to the current financial year, we need to record them. Do you understand? We need to include them. So, what is our telephone amount?
Our telephone amount is
17,800.
17.
17,800. And then we add the 540 that belong to March.
540.
So what is our
Yes.
So what is our total? That will be 18,340.
18,340.